But so can you just kind of give us an example of, the way that this invisible infrastructure works? So let's say I have a company in India and I want to import oil from Saudi Arabia to then refine it in India. How does this invisible infrastructure actually work to facilitate this?
Sure. So the most important choke point in the global economy is the dollar. Oftentimes, people think of the dollar as the global reserve currency. And that's true. Central banks around the world hold about 60% of their reserves in dollars. The second place is the euro at about 20%. And currencies like the RMB are 5% or below, so significantly below where the dollar is. But when it comes to the dollar significance, it actually goes well beyond this reserve currency role. It's really the preeminent currency across all use cases of money. It's the preeminent store of value, medium of exchange, and unit of account. So in terms of store value, we mentioned the reserve role. There's also the fact that 70 to 80% of global equity market capitalization and debt markets are all based in dollars. So basically, if you're a major company around the world, if you're a major asset manager around the world, you're going to have a huge allocation and huge exposure to the dollar. But to use your example of an Indian company importing oil from Saudi Arabia, this will sort of explain why these other parts of the dollar are also just as significant, the sort of unit of account and medium of exchange. So the oil market is priced in dollars, and you need a framework for a massive market. So oil still is the biggest sort of globally traded commodity. So the fact that the entire market is priced in a single currency is very helpful, because if you had different prices, a dollar price, a ruble price, an RMB price, a euro price, there would be fluctuations depending on what type of currency we're using. You wouldn't actually have an integrated market. It wouldn't be a commodity. So the fact that oil is benchmarked in dollars, and of course the big oil producers like Saudi Arabia are want to get paid in dollars and then recycle the dollars, is very significant. But even at the sort of infrastructural level, and this is the invisible infrastructure that you mentioned, the payment itself is very interesting, because let's even say that the Saudis didn't want to get paid in dollars. They wanted to get paid in reals. And this could be the case for some other transaction. An Indian bank isn't going to hold Saudi reals, right? It wouldn't make sense for every bank around the world to have access to every single possible currency they might encounter. So generally speaking, what happens is banks have large stocks of their own home currency, because their corporate customers will need that currency to pay employees and to just run their everyday operations, and then access to dollars. So the dollar is sort of this way station that's used for any other type of transaction. So in that example, a Indian company might take their rupees that they have, make a foreign exchange transaction to exchange those rupees for dollars, and then the dollars would then be exchanged for Saudi riyals. So there'd be two foreign exchange transactions just to sort of make that payment happen, and both of them would include the dollar. And that's why I think one of the most striking statistics about the dollar's dominance is that the foreign exchange market, which is by far the biggest financial market of them all, with over $7 trillion in daily turnover. And it just goes to show how much this is capturing. 90% of all of those transactions have the dollar on one side or the other. And as a result, if you're the government that controls the dollar and can tell companies, individuals, or even entire countries that they're cut off from the dollar, it gives you tremendous leverage.